Good morning and welcome to the American Enterprise Institute. My name is Stan Voiger, a senior fellow here at AEI, and I'm delighted to host this event on inflation and macro policy in Latin America. Inflation is currently, as all of you know, an extraordinarily salient and politically contested issue here in the United States. The CPI rose by almost 8% over the past 12 months, well above target and well above expectations a year ago. It poses major challenges to policymakers because the measures that will reduce inflation are also understood to reduce output and employment. Latin American policymakers face similar trade-offs in an at least partially similar macroeconomic environment at the moment, with significant supply chain shocks and demand that has fluctuated wildly over the course of the pandemic. Factors that are of greater importance to policymakers in many Latin American countries than here in the United States are commodity prices beyond oil and gas, external shocks from overseas monetary policy, and implications for exchange rates. We hope to illuminate some of those considerations today. Now, the proceedings will unfold as follows. We'll first get to enjoy presentations by our esteemed panelists with some room for discussion in between. After their remarks, we'll have a conversation between the five of us and we'll answer any and all audience questions. We will end the conversation a little before 11:30. You can submit questions to john.kearns, that's Kearns, @aei.org, or on Twitter with hashtag AskAEIEcon. Now, let me briefly introduce our panelists in order of their opening remarks. First, we will hear from Elan Goldfine. He is director of the Western Hemisphere Department at the International Monetary Fund here in Washington and was governor of the Brazilian Central Bank from May 2016 until February 2019. Jose Gregorio will then speak. He's dean of the School of Economics and Business at the University of Chile and a non-resident senior fellow at the Peterson Institute. He was governor of the Central Bank of Chile from 2007 until 2011. He'll be followed by Fernanda Nechio, Vice President for Sustainable Growth Research at the Federal Reserve Bank of San Francisco. Fernanda served as Deputy Governor for International Affairs and Corporate Risk Management at the Central Bank of Brazil until May last year. And finally, my colleague Steve Kamin will share his thoughts. Steve is a senior fellow here at AEI as well, prior to which he is the Director of the Division of International Finance at the Federal Reserve Board. With that, Elan, let me turn to you first. Please take it away. And thank you all for participating today.
Thank you, Stan. Thank you, the American Enterprise, Steve, everybody for the invitation. It is a pleasure to be here and to be part of this discussion of a very important topic on inflation. What I would like to do is to share my screen and let's see if this is working. Let me share. And let me see if this is.
Yep. Oh, wonderful.
You see the presentation?
Yep. Perfect.
Okay. Let me just make sure I have here. I think now it's better. No? No.
No, now you stop sharing.
Yeah, so let me do it again. Let me see the one. Is it fine now?
Yep, perfect.
Okay, thank you. So inflation in Latin America, I think we are in a very particular moment where we are having a shock coming from the war of Ukraine on top of another shock that was the reaction to the COVID shock. It is quite unusual that we have this scenario of shock over shock, and that is what makes this moment very special in terms of inflation. So I'm going to talk today about the evolution of inflation in Latin America before the second shock, which was the war in Ukraine. I will talk about the main drivers of inflation in Latin America. Then I will talk about the second shock, which is the impact of the war in Ukraine on inflation afterwards. And then finally, what does it mean for monetary policy? I think we are gonna have more difficult trade-offs. So where was inflation before? We had the headline consumer price inflation going up. You see here on your left side the inflation in Brazil, which is the the light, but all the countries are having much higher inflation than we thought. And that has led to also core consumer price inflation going up. And that is the reaction of both the shock, but also the second shock. And as you can see in the right-hand side, you have now impact of food, energy, and the core. So you have the first shock that has entered the core. And on top of that, if you can see the red of energy and the blue of food, we have another shock coming from the Ukraine war. Latin America has, if you look at the impact of global factors relatively local factors, global factors have a large influence in Latin America, at least compared with the US. You see that the blue part of the decomposition is the global factors. So through exchange rate, for import prices, in Latin America, you do get quite a bit of impact from global shock relative to the US or even relative to the other emerging markets. And we have seen that the commodity price index is correlated to that too. So where are we? We now we are having the second impact, and the second impact will come through where they usually come to Latin America, which is the import prices and exchange rate. So you see that the reaction, the higher the import prices they get in the CPI, and when you look at the real exchange rate, the more depreciated, the more you have it on the CPI. So that's the way this global inflation feeds into the inflation in the region. And on top of that, when we have a very strong rebound in 2021, private consumption tilted towards goods inflation, generated a major shock in inflation, and that has led to a broadening of the inflation. As you can see, services inflation, which were very low during the pandemic, has started to go up. That's true in the US, but it's also true in Latin America. This is LA5, which is the largest 5 Latin American countries. So, big shock coming from abroad, commodities, it hits headline inflation. In a rebound moment, it gets into the core, services inflation are reacting, and that's what led to an inflation, which on average in Latin America was 8.5, much larger than you used to have. You do have other issues. So, for example, now we're going to have tighter labor market, which was lagged. You see that in Latin America, we still have quite a bit of a gap in the right hand of this graph. You see that the rebound happened before, but now we're going to see employment reacting, and that is the moment where this broad-based inflation will actually spill into future expectations also because demand is there. We are seeing, of course, a deceleration in growth from 2021 to 2022, given all the shocks we are facing, and also the normalization of growth. Latin America usually has low growth, so 2022 is a much lower growth compared to 2021, which was a rebound 2022. But we're still under quite a bit of pressure of inflation. Before the shock, before the second shock. So we're talking about here a shock over another shock. That's the problem with inflation. If you just had an inflationary shock over a different shock, but now you have two shocks. So when the first shock was starting to wane, to moderate, and we've seen that, as you see in the left hand chart, Brazil, Chile, the producer price index started to moderate. And we know that the pass-through from the producer price inflation to the CPI has some peak, and then it usually moderates. Now we are seeing another shock to the producer price inflation. So I would have said there was a shock, big inflation, monetary policy reacted. You've seen moderation in PPIs. It will feed into CPI. We're going to see the end of the story through 2022, 2023. Now we're having a new shock on the PPI that does not allow this moderation that we are seeing in these graphs. So what happened? Well, first, we have seen a big shock. Commodity prices have gone up, so food, oil, but for the region, we are seeing some quite favorable in terms of trade. So you see oil, some countries that export oil in the region benefit, but also copper, iron ore, soybeans, everything went up. So from the point of view of the balance of payments, I believe that the region has fared quite reasonable because the shocks from the point of view of energy are compensated for other commodities, and the region tends to export either oil or copper, iron ore, or other commodities. However, when we're talking about inflation, which is the subject here, it's all negative. So food inflation, oil, they all mean have very high inflation. And the calculation we have made, which is the middle chart, you see Brazil, Chile, Colombia, Mexico, Peru, an impact of oil shock on top of a 10% price shock. So if you sum the two of them, which is a 30% oil plus a 10%, you see these circles, which you see that they generated another 1.5 percentage point inflation. So that's not a small thing to go. However, given that in terms of trade shock in the region are not bad, you see that the financial indicators are relatively okay. They're all actually up. So if you look at the equity prices, they're up. If you look at the exchange rate, they have appreciated. When you look at the basis point on the spreads, they actually went down. So at the end of the day, there has been quite a benign impact on financial indicators so far. I say so far because the Ukrainian war may still lead to a second round, which will be a financial distress. We have not seen it. But if it happens, and I'm not saying it will, but if it happens, then the impact of the region will be much more severe than we have seen up to now. So what the central banks are doing, they have reacted. And when you see the slides, they reacted on your right-hand side, you see the policy rates have gone up, these circles, they are gone quite up relative to where they are, which is the line. So in Brazil, from 2 to very high double-digit rate, in Mexico it went up, Colombia, Chile, Peru, all of them are reacting. And the consequence of that is that when you look at 3-year ahead expectation, which is our measure of anchoring expectation in the future, they're all very well anchored when you let the shock occur in expectations for 1-2 years. When you look at 3 years ahead, they're still being anchored. So the question now is, with this shock of a shock, what can central banks do to preserve their hard-won credibility, including the shock that they had on the COVID? And probably they won't be able to just sit and say this is a supply shock, and we just let it go, because they are already with very high inflation. They have already with very impacted short-term expectations. So in order to have the long-term expectations remain where they are, they will have to react. And second, with food inflation and transportation issues, you'll see that the first decile of inflation is higher than the fifth and is higher than the 10th decile, which means that there is a distributional issue here. If you allow inflation just to go up, let it accommodate a supply shock, you'll hit the poor more than the rest. And that's something that central banks are now concerned. So just to conclude, inflation in Latin America accelerated and has become more broad-based in 2021. That's the core I show you. Initially was boosted by global factors, but has been propelled by domestic factors too, private demand recovery, rotation towards good. The way it enters the region is import prices and exchange and depreciation. And as I mentioned, this is a very different shock. It's an inflationary shock on top of the previous one, the Ukraine war, on top of the COVID shock. That means more difficult trade-offs for central banks. They will have to use effective communication to explain why they cannot just let this supply shock go accommodate, and they will need to continue tightening in order to keep inflation in check. And those expectations that I show you on the long term well anchored. Containing inflation is also important for equity reasons. The poor have been hurt the most. So that's it. Back to you. Thank you.
Thank you, Elan. I want to give the other panelists an opportunity to ask questions, but I wanted to first ask you, you showed a figure of a measure of supply chain disruptions that showed that they were now a much smaller factor for Latin America than for the US. Could you elaborate on that a little bit? Why is that the case? Why is that still such a big factor in the US relative to Latin America?
Well, I think the insertion of the region in the global chains is smaller, of course, than the US. US is clearly inserted in this supply chains. Some of the countries in the region are very well open, are part of that, but there is a large share of Latin America that is more closed. And when you look at the supply chains, they're basically very limited. So that's not good, especially for competition, for growth. But when there is a disruption, it hits the US, it hits the countries that are very globalized. And the region is less globalized in some of the countries. And that effect. And also it's true that when you look at the impact of inflation, it's much more important. Import prices, depreciations. This is where inflation gets into the system in Latin America.
I see. Excellent. So, Fernanda, Jose, Steve, any questions for Elan?
Yes, I have a question for Elan. In the United States, our very generous fiscal transfers during the pandemic have been kind of like identified as one of the factors in the US inflationary surge. In Latin America, there seems to be quite a diversity of fiscal responses. Brazil, for example, had very generous increases in fiscal transfers. Mexico, not so much. But all of them have had high increases in inflation. So I was wondering, what Elan thought about the kind of like the fiscal factors in the inflationary surge in Latin America.
So when you look at the region, thank you for the question. When you look at the region and you factor these domestic issues relative to the global and compare them with the US, you see that 75% of the inflation you can attribute to global factors, which are import prices. So that's basically where these huge global shocks affect the region. And that's why we tend to attribute less to domestic factors. However, when you look at the private demand and you look at the rotation towards goods, you know that there's an issue of more demand for goods. There's an issue of getting into the headlines and into the core, and after a while to service inflation. So private demand and domestic issues and fiscal issues there also had an impact, and you can see it clearly. So I think Fiscal issues affected demand. Demand affected demand for goods. It led to headline and core, and in the core, services was there. But in addition to the usual channel, which for demand, there is a channel in Latin America where fiscal affects inflation, and I can explain where it comes from. Whenever you have these global shocks, commodity prices going up and prices going up, usually what happens in Latin America is that the exchange rate appreciates because it's a positive terms of trade. So there is a compensating effect from import prices for the exchange rate. But what happened last year was that we did not see the currencies appreciate this time around. And partly because some of the countries had come out of the big spending with less fiscal space, with more doubts about the issues. So the exchange rate did not normally appreciate, which will be the mitigating factor. It kept it depreciating because we had capital outflows. So you have capital outflows despite the terms of trade shock. So the exchange rate did not do the mitigating factors. When you look now, we actually see some appreciation in some currencies, which is helping a little bit the food and the oil shock. So fiscal issues in the region are important for private demand, but also from the point of view of confidence, debt issues, and capital flows.
Thank you. Fernanda, Jose?
Sure, I actually have a question as well. Elan, you talked about the inflation and the worries about inflation expectations and so on. A lot of the conversation in the US goes around the some type of inflation wage spiral dynamics. And the reason is because, labor markets in the US are hot, let's say. Can you talk a little bit about how do you see that for Latin American countries? I guess we should be seeing, when we're talking about the rising inflation and the worries going forward, it has to come through labor markets somehow. But I would say that conditions across different countries are very different. So how to square that?
So as I show you with graph, the output gap and employment is in the US much more tighter than the region. So the region, in output, there was a big recovery, but in employment, you only see the continuation of the employment recovery now. And I don't think we've seen the labor market as tight as in the US. I think it's a different phenomenon. So I think the risk of a spiral price wage inflation is smaller from the demand point of view, from this huge demand, tight labor market, and then the spiral. However, the way I see the region is that you can still get some secondary effect of the shock, getting into expectation and getting into prices, even though labor markets are not as tight as in the US. All the history of inflation, all the hard-won credibility is there, but it's still not as strong as the credibility of the US, where you did not have this history and these issues of. When you look at the central banks and when they raise interest rates, they were able to anchor expectation 2 years ahead. Although inflation in the short run became broad-based, even without labor very tightly. So they had to raise interest, they kept it, and now you have a shock over shock. And what do central banks do? They're already tightening policies. As you mentioned, labor market is not so tight. So the trade-offs are much more difficult here because you already raise interest rates, you were able to anchor long-term expectations, but your short-term inflation is very high, and you get a shock on top of that. So what do? If you are in the US, you have a tightened labor market, the risk of wage spiral. You are still beginning the tightening. I think it is still, of course, there are trade-offs, but I think the trade-offs in the region are more stark than in the US. The US, I think it's a clear recommendation of starting to raise rates and fight inflation. In the region, you'll have to raise rates. You'll have to think about anchoring. But as you mentioned, labor markets are not so tight, so there is an issue.
Fantastic. Let's go to Jose to hear his thoughts.
Yeah, thanks. I didn't ask question because I'm trying to answer them myself.
There you go.
When I prepare my presentation, you can see my.
Yep, fantastic.
Okay, so let me just very briefly, I will show some data and provide some interpretation, and then discuss a bit the policy response, which is kind of what we're interested in and looking forward. In Latin America, I should compare Latin America. When I talk about Latin America, I talk 5 of the main largest countries. I leave out Argentina and Venezuela for obvious reasons. I don't want to pick on them now because we pick on them everywhere. So I take the Brazil, Chile, Colombia, Venezuela, Mexico, and Peru here. And then I have some other countries. I like to look at other countries. And I take the usual Asian countries, China, Indonesia, Korea, Malaysia, Philippines, Thailand. And then I take South Africa, Australia, Turkey. Today, we cannot talk about inflation and compare with these countries when you have 2 digits. And so it's especially Australia and New Zealand that are 2 commodity exporters. What is interesting is that the rise in inflation in Latin America has been somewhat higher than in all the rest of these countries. So inflation compared to some advanced economies, okay, but Latin American increasing inflation among emerging markets, and especially when you compare with Asia, has been much higher. And this is the red line. So you see Latin America only compare perhaps Thailand, and New Zealand, they may have on this group of countries inflation. So it is a concern. It's a concern. Why? Facing some common global shocks and some similar global shocks, having the same sort of initial shock, which is the pandemics, we have such a different response. And what is important also to understand, I'm basically looking from January 2021 to February this year. So this is the comparison that I do for the inflation rate. And this is, there are issues, and before going to that, there are common factors, and trying to pin down exactly what is internal and what is external is kind of complicated because some of the external factors are exacerbated by domestic factors. And I want just to mention one, because there are a lot of issues, and I think that there will be more in the discussion about output gap, as Fernanda mentioned, the state of the labor market. So there are many factors. In Latin America, one thing that has been different is that the depreciation of the currency has been much higher than in the rest. Only in South Africa, in this group of countries, we see inflation between 20 and 30%. The depreciation, in this case, depreciation, I'm taking it from the pre-pandemic level. Why? Because exchange rate takes time to pass through to inflation, and the turmoil started with the pandemic, the depreciation. Indeed, this year, during the first quarter, we have seen some strengthening of currencies in Latin America. This provides some relief in the sense that the prospects are that inflation may be reaching or may be closer to the peaks, because the one of the important factors that's pressuring inflation, that has been the exchange rate, is already stabilizing. But we have sharp depreciations. In the case of Chile, because the turmoil started 3 months before with the social unrest, I just started in October. Now, what is and this I want to mention comments by Elan. Is this internal or external? What does explain that countries, commodity exporters, that may be somewhat benefiting compared to, let's say, countries like in Asia, that they have less than 10% depreciation, okay? Why they have such a large depreciation? And such a large depreciation is related, I think, beyond the normal things about the external adjustment, is a lot of fiscal weakness and political turmoil in the region. So is that external or internal? I don't know, but it's good that the exchange rate is adjusting, because that adjustment, but one cost that brings is inflation, and that inflation may require a more a tightening of monetary policy. So I think that this is. So it is difficult to explain why currency has been so weak in the region when you compare with other emerging markets, and there are a lot of domestic factors, particularly, for example, in the case of Brazil. There are a lot of uncertainty, risk premium, and that also weakens the value of domestic assets. So I want to mention that. The policy response, policy response, when you look at these countries, except for the case of Russia, that Russia at this stage, we have to leave it aside. I just was cutting to February, not adding data March, and Korea a little bit. But in Latin America, monetary policy have been tightening severely. I don't have the whole, this is at the Bloomberg data, but this has been, especially in the case of Brazil, Chile, Colombia a little bit less, and Mexico, Peru, they are moving, but they may keep moving. So we may really face, and so the issue is this the right way to go, and why Latin America is different, and are these differences in inflation performance also justify differences in monetary policy. So just let me, before I go to some discussion, see these numbers in another way, because I just sit down and start looking at numbers at the Bloomberg screen. And the other way to see is with what's going on with monetary policy expectations and inflation. This is the same group of countries. For some reason, when I was doing the graph, I put now Latin America at the right. So this is sometimes in the right, sometimes in the left, to avoid any kind of
outstanding.
Right. I don't want you to, but now in this case it's at the right. What is interesting is that inflation in all Latin America is way above target. If you look at the rest of the countries in Asia and South Africa, what you see is that inflation is still within close to target. So this is the thing that a way about target. So all of that would justify monetary policy tightening. And the inflation forecast. Now, this is the Bloomberg inflation forecast, which is the forecast for the end of this year. It's not the relevant forecast for monetary policy, which would be at the horizon of monetary policy, but this is for what that can get a relatively homogeneous data. We see, contrary to the rest of the countries, what we see is that in Latin America, inflation, the expectations are that inflation will decline, but still towards the end of this year, there will be inflation will be still be away from the expectations. And then, of course, monetary policy, which is the blue line, has increased a lot. So the issue, and this I want just to start wrapping up my what did it trigger inflation? So was external, was foreign? We have, in the case of Chile, a long discussion, because in Chile there was a fiscal expansion we have had in history, I think, with the fiscal deficit last year in the 2 digits, and was not cyclically adjusted, was the actual discretionary fiscal policy, extremely expansionary. We had also the withdrawal of the pension funds, which was a huge amount of the saving, so a lot of demand. And now the central bank is forecasting that the output gap output is above full capacity for about 4 to 5 percentage points. So it's quite a large overexpansion, overheating. So of course, what the issue, there is a big, and intellectually we will discuss whether it is internal or external. As I said, I'm not sure how we should qualify the exchange rate. Of course, we have had a lot, and there is a trigger, or there is an initial shock everywhere in the world, that is commodity prices disruptions in the supply chains. I think that those are kind of the global main initial factors. But what's the problem? And I was expecting that the IMF, and I'm sure they will do this work very soon, or otherwise I will start doing it, which is I was thinking while we were discussing all of this, is what is the pass-through from non-core inflation to core inflation? So basically, how is the dissemination of these non-core shocks, commodities, oil, energy, to the rest of the economy? And my interpretation is that we have had a supply shock that has been with a duration longer than the one that you need for not acting in monetary policy. When there is a short-run supply shock, you can wait, okay? But this shock has been long. We have a lot of uncertainty how this will continue with the Ukrainian and Russia war. So it needs a policy response. It needs a policy response because this supply shock has been more persistent than the one needed for not acting. This has been coupled in some countries. In the case of Chile, we can then start discussing in the case of Chile and perhaps in other countries in the region, in Brazil, with a very strong demand. Sometimes demand does not fit exactly to growth because now full capacity with all the disruptions that we have in labor market, the lack of supply, it's not obvious where it's full employment. So that could be behind. So what's happened and what's the concern for me from the policy point of view? The concern from the policy point of view is that inflation has been persistent, is that there is a wage price spiral, that this may trigger a wage price spiral. And as we have seen in this Latin American country, there is a risk of an anchoring expectations. What is implied from the point of view of the outlook? If this is the case, inflation will take long to reduce it and it will be more costly to reduce it. So staying somewhat ahead of the curve. And what many countries in the region, I think that has been the appropriate response. Discussing and whether this is external or internal, I think that in some instances could be a very interesting issue. Today is not relevant for the conclusion of monetary policy, which is the need for tightening. Tightening, where it will end, how sharp it should be, well, that's depend a little bit on the country by country basis. I cannot say, well, Chile is enough, or they should keep, or what's happening in Brazil. I think that the direction is the correct one, and it also provides another thing that is important. It's most likely we'll start observing decelerations in all economies late this year, early next year, and there will be this time monetary policy space to avoid an excessive or too sharp of slowdown. So I will stop here and remain for the discussion. Thank you.
Thank you very much, Jose. I think maybe Elan, if you would like to respond, there were a few comments that went relatively directly your way. So please go ahead.
So very, very interesting, Jose Epo. One question and one comment on the question. I think there's a very interesting discussion whether the inflation in Latin America is foreign or is domestic. And I think the core of the answer is the exchange rate. As the exchange rate depreciated last year because of external factors or where they were fiscal considerations that did not allow the exchange rate to appreciate as they would usually do in these cases. So you can say, well, if you look import prices in domestic currency, they went up quite a bit. But your view is, and I concur with this view, is that they went all the way because the currency did not appreciate it. They actually depreciated it, and that shouldn't be the case. So I agree with that. But then the question I want to ask is, what's going on now? Why the currency is appreciating now? Has the fiscal situation changed so much from last year to the beginning of this year? Why the currencies are now actually reacting in the appreciating way and not before? So that's a question. And the second is a comment. I think that the usual prescription, which is you have a shock, supply shock, you accommodate the shock, you only look at the secondary effect, and you have the luxury to let it go. It's very difficult this time around, and if central banks will just ignore that we're having a shock over a shock, which means you're having an inflationary shock on countries that have much higher inflation than they usually do. And that's why I don't think you have the luxury just to say, this is business as usual, just a supply shock. Let's wait and see and just react afterwards. So I agree with you that this time around, this time is different. We don't like to say it, but maybe this time is different. Inflationary shock over countries that have very high inflation.
Yeah, yes, two things. I will answer the issue about appreciation, the recent appreciation, just thinking a little bit on Chile, which is, I think that illustrates what's my point is. First of all, if I could explain exchange rate fluctuations, I wouldn't be here. I would be doing Forex transactions, because it's quite difficult to try to expose exactly what happened. But in the case of Chile, we have a sharp depreciation that was extremely linked and was very tied to the political uncertainty. And this started with the social turmoil of late 2019. Now, it seems that has part of that political premium has dissipated. Has dissipated. Why? Because the government that provoked a little bit more market fear has been much more reasonable, and all the things say, well, it's a leftist government, but it's in a democracy. That's part of the game. So things are normalizing. But there still remain uncertainty. The same may be happening in Brazil. So part of that is two factors. One is that some of that extreme uncertainty, pandemic, political response, the future of the region, so has been declining. And at the same time, we have had this year with much better terms of trade. So if you cover this, we have some appreciation. Still, if you ask me, Chile, with no uncertainty, with no concerns, with no big fears on constitutional change, I think that should be much more stronger the peso. So this is what's moving. The second thing, it's interesting because the supply shock, we tend to think the supply shock, it requires a different response from a demand shock. So I was thinking a lot about this because the issue in this part of the question is the source. It's not the source, it's the source to know what's the optimal policy response. So when we have a short-run supply shock, so we have to distinguish about the persistence of the supply shock, and second, the propagation. In Latin American economies, and that's what I was asking you to do at the fund, this pass-through from non-core to core. In Latin America, I would guess that the propagation of external shocks, the propagation of commodity prices to the rest of inflation because of a short story of low inflation, because of still remaining some fiscal and other weaknesses, maybe the pass-through may be higher in Latin America and other countries. And the only way to control that is to applying a less expansionary monetary policy on the rising inflation.
Jose, sorry, you mentioned this briefly. It sounds like you think that in Chile specifically, the new Boric presidency and even the constitutional convention, that those will not have particularly large macroeconomic implications, or am I misinterpreting that?
Yeah, they won't have as large implications are as we were expecting. What I'm saying is that the degree of uncertainty is narrowing. Now, we can do then a meeting about Chilean constitution. I am extremely worried. I'm extremely worried. I think that if you ask me, there was 6 months ago, there was an 80% chance that this country could derail and 20% that we can navigate. Now, we're maybe closer to 50-50. So that would be
good. Well, I see. So that's still pretty bad. I'm glad I.
Yeah, no, I'm just putting
clarification. Okay, good. I see. Steve and Fernanda, do you have questions, or shall we go to Fernanda's opening comments?
Why don't we go on?
Sure.
If we have time at the end, then we could have fun.
Yeah,
Great.
Fernanda, so you please go ahead. Oh.
Yeah, I will start sharing my slides here. Can you see it?
Oh, yeah.
Okay. Well, first, thanks to the organizers for inviting me to participate on this interesting panel. I have to say that although the three of us, or the four of us actually, didn't really coordinate on our topics, we managed to cover different aspects of the same type of question. So I would say that that's interesting. So what I'm gonna do here is talk about basically almost focus on a little bit of the research that I have been doing here at the San Francisco Fed with some of my colleagues. And I'll be talking about what is behind the recent, one of the aspects behind the recent inflation surge that we are seeing worldwide. So this is basically a picture that is very similar to one that Jose just showed us. Basically, it's showing that higher inflation is a worldwide phenomenon pretty much. We are seeing more of it in some countries than in others for different reasons, but we have higher inflation basically worldwide as a result of the pandemic. And it's interesting that we've been through a long period of low inflation in the US and in other countries as well, but we saw a significant inflation surge more recently. I kind of like to think of the Econ 101 version of every type of macroeconomic phenomenon that we see, and this is very basic, but through the pandemic, we saw both a demand, at the beginning in particular, both a demand and a supply contraction. And at the beginning, you didn't see as much of an inflation surge, given that you had these two effects in place. But over time, to counterbalance the effects of the pandemic, we saw significant measures being put in place to counterbalance or reverse some of the decline in demand that we were seeing happening as a result of lockdowns and the policies that were put in place for health measures, right? So what I'm gonna do here is talk about one of the aspects behind this demand boost that we saw as a result of the measures implemented to counterbalance the effects of the pandemic. So I'll be talking about this shift pretty much from D1 to D2 and focusing on one aspect of it. First, a simple chart basically is relating what we have been seeing in terms of inflation increase across the world and the amount of increase in fiscal spending that we saw more recently as a result of the pandemic. And this is pretty much a first bypass in looking at the fiscal boost and its impact on inflation worldwide. And you can see that you find a positive relationship between, the increasing spending relative to a recent average and also the increasing inflation relative to the recent average before the pandemic. So this is pretty much a first check that you can find some relationship between these two variables. What I do next then is kind of go back to my own research here at the bank, at the San Francisco Fed, and try to grasp more formally into whether you can actually find this relationship in the data. And here, I start with the usual caveats from researchers that this is a really hard task. First, because this is a general equilibrium question. It's really hard to disentangle supply and demand shocks, especially as they are happening, right? I mean, we are still going through the effects of the pandemic and the effects of shocks that hit countries worldwide. And so on top of being hard to disentangle general equilibrium effects, you get into data series that are affected by sizable shocks and unprecedented events. So it's very hard to use, for example, historical data to understand what is happening right now from a research perspective. But in any case, we are trying to do that here, but always keep the caveats in hand. Here, before I get into the rest of the world, it's a kind of a look at what is happening in the US versus some of OECD countries. And everything that I'm showing in this slide here is based on a recent publication that I have here at the San Francisco Fed. Basically, what you see is that, the first picture on the left-hand side on the top is showing what happened to real disposable income in the US during the pandemic. And you can see that the type of movements that we've seen, it dwarfs everything else that we ever saw basically in the country. In the bottom chart, I'm comparing the movements in real disposable income in the US versus the rest of OECD, a sample of OECD countries. And you can see that what happened in the US was actually much larger than we saw in other countries too. So part of the presentation here, particularly in this slide, goes back to a question from Steve early on the fiscal side of the inflationary pressure that we are seeing. Not surprisingly, we also see that in the US, inflation is much higher than in its OECD peers. And then what I do in the two pictures on the right-hand side, basically is try to extract more formally the relationship between fiscal and inflation in the US relative to other OECD economies. And what we can see here is that you can actually attribute a sizable portion of the inflation in the US to the fiscal boost that we saw during the pandemic period. So basically here, what I'm doing a little bit more formally is estimating a Phillips curve in a panel framework and looking and using the pandemic and this fiscal boost to identify and measure the impact of the increase in real disposable income in inflation. And you can actually find, particularly in the picture in the bottom right-hand side, you can see that the counterfactual inflation, had the US didn't have those expansionary policies or had expansionary policies that were similar to the ones that we had in some OECD countries, you would have a much lower inflation currently. So you can actually relate more formally the fiscal boost to the readings, the sizable readings of inflation that we have in the US relative to OECD countries. So the follow-up question is how much of that you can actually do for other economies, right? And that's I would say that it's an additional difficulty because usually you have a much better quality data and at a higher frequency for OECD economies and for the US in particular. But what I try to do next is to apply the same type of exercise to a sample of worldwide and other countries, which include Latin American countries and other emerging economies as well. And this is based on a research that is not published yet, and I'm still working on it with some colleagues here, but it has the same flavor of the previous slide that I was just showing, where I was trying to estimate more formally the impact of fiscal on inflation. Here I'm using a panel of countries, which also include, as I mentioned, Latin American countries and emerging economies. I have three pictures here. If we start with the one in the left-hand side, basically showing that, inflation gets a boost out of fiscal measure during the pandemic. So it's similar to, it has the same type of flavor of the previous slide. And it's showing that, the boost happens after a few months. Then on the charts in the left-hand side, the one that is called consumer versus firms, is trying to exploit, I think, one important feature of the differences across countries, the measures implemented across countries, which are that not only countries did different levels of fiscal boost to the demand, trying to counterbalance the effects of the pandemic, but they also implemented different types of policies. Some countries implemented policies that were more targeted to consumers with fiscal transfers directly to consumers, and that was the case for the US, for example. Some other countries implemented measures that were more targeted to firms in trying to avoid bankruptcies and closures, and basically to provide a bridge for firms to be able to survive the pandemic period. And what I'm finding here, and again, this is really preliminary still, is that fiscal measures that were targeted to consumers have a much larger impact on inflation in countries, right? So the average effect of of fiscal transfers or fiscal measures implemented during the pandemic on inflation was much larger in countries that focus on having measures targeting consumers relative to firms. So I think this is an important aspect of the impact of fiscal on inflation. But this is still a work in progress, and I'm eager to actually get to some final results related to this and to be able to share out there. Now, I think I'm going to finish with this slide. I think a lot of the points that I want to make here were already raised, but this is how I think basically lists a set of risks to the inflationary outlook that we have currently. And they are particularly important for Latin American economies for various reasons. So, we are in a period in which we are seeing inflation very high and much higher than it was historically for a lot of countries in the world. We are facing risks of an anchoring of inflation expectations. So that means that, even if we're going through a new supply shock, you have to think about it carefully, because you're seeing a supply shock, as Elan mentioned, that is happening on top of already inflationary scenario. So the risks of an anchoring of inflation expectations become much higher in this case. So we already are in an environment of high inflation, and we are being hit by a new shock. Latin American countries and emerging economies in general have a higher degree of inflation indexation. That is something that has to be taken into account as well, and adds to the risks associated with the inflationary scenario. We are facing additional supply shocks, as we all mentioned, and there is always a risk of having some demand boosting factors being added to economies worldwide because of political reasons and the temptation of pleasing the consumers and firms in general. So why am I bringing this risk to the outlook? Well, basically because as we saw in the previous two slides, we are still experiencing the impact of the recent boost to demand on inflation. And on top of that, we are getting into a situation in which we have an additional supply shock and a series of risks of an anchoring inflation expectations, indexation, and so on that are possibly and will likely feed into the inflationary pressures going forward. So I'll stop here, and I'm happy to answer questions and talk more about this. Thanks again for inviting me to participate.
For sure. Thank you, Fernanda. Let's see our panelists. Any questions? Steve, go ahead.
Oh, I'm sorry. I don't mean to.
No, it's okay. Steve's hands is up, but I'm not sure if that's intentionally.
All right. Anyway, so I thought that research was very interesting, Fernanda, and I have a comment actually, which is I think you're finding that fiscal policy focused on consumers is more inflationary than fiscal policy for businesses might be very useful in helping to explain why a lot of countries where there was a lot of fiscal expansion, but it was more focused on businesses and keeping people employed, that they experienced less increase in inflation than economies like the States, where we just basically sent households a lot of cash. So I think that's very promising. Sort of like, since you focused your presentation on the US a bit, let me ask you a US specific question. Given that US fiscal policy has been so important in propelling US inflation, and given that the fiscal impulse in the United States is now turning negative, does that kind of suggest that maybe, that basically it was appropriate for the Federal Reserve not to basically pull the trigger on tightening too quickly, and that indeed going forward, we might see some significant reduction in inflation pressures?
Thanks for the question, Steve. So, if everything else stays constant, what the charts that I showed in the research based on the US versus the OECD is telling us is as the fiscal impulse dies out, we're going to see less and less pressure on inflation. But the big if everything stayed constant is a big statement, right? Over time, it's possible that the boost to inflation and the increase in inflation can affect inflation expectations going forward and so on. And that actually changes a little bit of the dynamics and the effects that you have from the fiscal impulse by itself. So on the one hand, you would expect that as the fiscal impulse dies out, you have less of an effect on inflation. On the other hand, you also may be having already effects of inflation that are widespread in the economy, and those could be a little more persistent than anticipated. So I think that's the kind of the type of lesson that you can take out of the charts that I showed here.
Excellent. Elan, did you have a question?
Yes. It's actually just, I want to ask Fernanda, because she mentioned all about this shock over shock that I also realized. I think it's important for us to distinguish if we had this shock this year, what will have been the reaction in normal times relative to what we are having now, given the initial conditions. So I want you to maybe digress about that, because sometimes it looks like we are treating it like a shock and it's always been good. But I think it's very different, this shock, given the initial conditions, than we will normally suggest.
I absolutely agree. I think if we were having a supply shock like we're having right now, as of 2018, 17, let's say, the conversation would be very different from the type of conversation that we're having right now. So initial conditions matter quite a bit. So we are coming from a period in which we already have a lot of inflationary pressure. And as you showed in your pictures, inflation that is slowly becoming intrinsic in the economy and affecting not only the supply-related, pandemic-related sectors, but also other sectors, and possibly wages as well. And then you get a supply shock. So that, I think, is a very different scenario from if we were having a supply shock in 2018, let's say. So I very much agree with what you're saying.
Excellent. I wanted to ask a question both for Fernanda and Elan, I suppose. Why is inflation in Brazil so much higher than in the other Latin American countries? What's the leading theory there?
Would that even in the case that that's an interesting comparison because Chile has had a much higher fiscal and demand response and didn't have, and it has a lot of inflation. But in Brazil has been quite a puzzling, this experience.
So I'll start. I think based on what I'm doing in terms of research, I think you can relate a lot of the inflationary pressures to the fiscal response, which was pretty sizable in the case of Brazil. In fact, if you compare Brazil to the US, it's not that different in terms of the size, despite being an emerging economy. You also have other characteristics of the Brazilian economy that are probably making a difference as well. You know, you have a higher indexation level. You also had a very high elevated depreciation throughout this period. So that feeds into the inflation pressure as well. And so I think those are some of the reasons that I would cite. That I guess I'll let Elan
we'll make it
as well.
Just a follow-up. I think that is very important what you're saying about fiscal, but there are two fiscals. One is a fiscal expansion that was very large in Brazil, no larger than in the case of Chile. So my concern is, could it be that Brazil is facing some subtle form of fiscal dominance? So more than just a demand shock, there is a financing problems that dominates the price level.
So let me try to I think there's a combination of issues. First, I believe that you had stimulus policies. There is the fiscal one that Peppo is mentioning, which is basically a lot of spending during the pandemic. That was a very large share of GDP compared to other countries. We also had monetary stimulus. We had 2% nominal interest rate, which will make it a negative number for Brazil. We usually have this positive spreads and positive rates. So that generated a boom, which is an important boom. But I think the fiscal two, the second part, which Peppo is mentioning, is relevant, which is people, the exchange rate did not appreciate as maybe it was supposed to happen during the commodity boom. But I don't think there's any fiscal dominance. I mean, you're looking now, the currency appreciating. I think it's just a matter of risks coming out of. Remember when Peppo answered about Chile, too much uncertainties. The uncertainties were very high. I think we were just out of the pandemic with too much uncertainty. Uncertainties are going down, and this is allowing part of the appreciation. That's, I believe, part of it.
Well, excellent. So unless there's more on this, I want to go to Steve for his remarks so that we have time for a little bit of discussion afterwards, maybe some questions.
Thank you, Stan. You can hear me?
Oh, yeah.
All right, great. Well, it's great to be here, to be able to join such distinguished experts on this important topic. Now, Elan, Jose, and Fernanda have already covered the causes of Latin America's inflationary surge pretty well. So I just have a couple of words to say on that. So this chart here compares the most recent headline inflation rates around the world, that's the y-axis, with their trend inflation rates in the 3 years before the pandemic started on the x-axis. And as you can see, the upward sloping regression line is super significant and indicates that the higher was a country's trend inflation going into the crisis, the higher is their inflation rate now. And I've shown the Latin America 5 countries we keep on referring to in blue. And I was kind of hoping that Brazil would be further to the right, but it's not, it's in the middle. So it suggests, so obviously Brazil's pre-pandemic inflation performance does not fully explain why Brazil's inflation is now higher than the other countries. But all that said, looking across all the countries in the regression line, this chart makes the point that inflation in Latin America and elsewhere are not only the result of pandemic shocks, both supply and demand, but they're also the outcome of pre-pandemic processes of wage, price, and expectations formation. And that in some sense is like the propagation mechanism that Jose referred to earlier, okay? And since that propagation mechanism, I think, is very importantly influenced by monetary policy, I want to kind of focus the rest of my remarks on that, okay? So your next chart here shows the policy rates for the LA5. Oh, actually, I went too far. And those are shown in black, along with the inflation rates, core and headline for all our countries. And I'm showing the states for comparison down at the bottom right. So 2 points kind of like stand out from this. The first of these is that all the LA5 countries lowered rates right away in response to the pandemic, a much faster response than in 2008 to the global financial crisis, and they've lowered into very low levels. And this doesn't even count the quantitative easing that several of these central banks also put into place. The second point to note is that all of these economies started raising rates shortly after inflation started to turn up, and to a much greater degree than in the United States, which just raised rates for the first time a couple of weeks ago, and other advanced economies. So the question that I kind of wanted to address is, well, have these Latin American central banks been raising rates too quickly, not quickly enough, or just the right amount? Now, in principle, as we've already discussed, central banks should look through transitory supply shocks while responding to cases of more persistent excess demand, okay? Now, your next chart, compares the policy interest rate, again in black, with estimated output gaps in blue, okay? And as you can see, only in Chile has output gone well above the estimated potential GDP, okay? So kind of, it looks from this perspective like the Latin American inflation is largely the outcome of supply shocks. But all that said, as we're well aware, even if aggregate measures of the output gap, are negative, they can be hiding pockets of excess demand and supply bottlenecks. And it's also true that in an environment of not so well anchored inflation expectations, even transitory shocks can have larger effects. So in the absence of a clear view as to what exactly is driving the inflationary process, and I think we can agree we're not positive about that, it's hard to do monetary policy, and it's equally hard to figure out whether it's being done appropriately or not. So for want of a better approach, my colleague at the AEI, John Kearns, and I have been comparing Latin American monetary policy to two different standards. Okay, the first of these is how have other central banks been responding to the pandemic? And the second is how has Latin American policy, monetary policy, during the pandemic compared to its pre-pandemic behavior? So your next slide here basically focuses on the first basis of comparison. And this is kind of like a two-dimensional version of charts showed both by Jose and Fernanda, and maybe Elan as well, but I think those two at least. So the x-axis is the change in 12-month core inflation from December 2020 to the present, and the y-axis is the change in policy interest rates during that period. And as you can see, the advanced economies, which are the green dots, basically have barely raised their rates regardless of how much inflation has gone up. On the other hand, the emerging markets, both in blue for the LA5 and in red for the other economies, have indeed raised rates a lot and more where inflation has risen a great deal. So if you look just at the regression line for this sample of countries, it looks like Peru, Chile, and Brazil might have been over tightening. But of course, as we're well aware, in emerging markets, inflation expectations may be not as well anchored. And so it kind of behooves them to tighten policy a little bit more than in advanced economies. And so if we take out the advanced economies and just look at the emerging markets, it looks like all the Latin American LA5 central banks are well within or even a little bit below the kind of like the mainstream of monetary policy. All right, so that's the first metric. The second metric that I want to talk about is the comparison of Latin American monetary policy during the pandemic period with its previous track record. And so to make that comparison, we pooled the data for all 5 of the Latin American countries to estimate a Taylor rule, which links their policy interest rates with the rates of inflation, the output gap, the lag policy rate, and the real exchange rate. And our results show first that over the last 1.5 decades, Latin American central banks have responded significantly to both inflation and output gaps, and by about the same amount. Second point is the coefficient on the lag policy rate is 0.9, which is a high degree of interest rate smoothing, but is something we generally expect of central banks. The final point is just that I noticed that the coefficient on the exchange rate is exactly 0, suggesting that these Latin American central banks have been, at least over the last decade and a half, focusing exclusively on inflation and output. All right, so now that we've got this estimated model in hand, we can use it to predict how policy interest rates in the region might have evolved during the pandemic, assuming the central banks had stuck to their previous reaction function. And as you can see, looking at Chile, the actual interest rates in red pretty much now match the predicted rates in blue. On the other hand, for the 4 other countries, the actual rates, again in red, are well above the predicted rates. So this suggests, at least for starters, that Latin American central banks have not fallen behind the curve. And this is confirmed, or at least supported, by another version of charts that I think all my predecessors have shown at this panel, which is that actual inflation here in blue well exceeds survey measures of year ahead expected inflation in red. So it looks like, again, inflations are pretty well anchored around the region, and at least as well anchored as in the US of A. All right, but returning to our simulation charts, so for the 4 central banks where rates have gone up more than the estimated reaction function, does that mean they're tightening too quickly? Now, this is a bit of it's a lot of a judgment call. My sense is that when governments are beset by significant fiscal and credibility and governance problems, all of which would tend to loosen the anchoring of inflation expectations, it makes sense for policy rates to rise more quickly than would be called for by Taylor rules estimated during more normal periods. So I'm pretty comfortable with the rapid pace of tightening in Brazil, Colombia, and Peru, noting especially that for those last 2 countries, interest rates are still quite low by historical standards. Now, I will say that with Mexico, I'm a little bit less convinced, okay? So to be sure, the erratic policies of the AMLO administration are not conducive to investor confidence. But fiscal policy in Mexico has been, if anything, overly restrained during the pandemic period. And Elan's Article 4 presentation report on Mexico, actually it was his predecessor's report from the IMF, kind of said the same thing. And so partly as a result of that quite restrained fiscal policy, Mexican output is further below potential, as shown by the bar on the bottom right panel, than in any of the other countries. It has the most negative output gap. So it's possible that for Mexico, maybe monetary policy should proceed a bit less aggressively. But obviously, there's lots of uncertainties, so I can hardly be confident in that assessment. So let me wrap up by noting that at a time when Latin America is afflicted by many severe problems, including the ongoing effects of the pandemic, inflation, fiscal difficulties, and political strife, it's at least, the region is at least fortunate to be able to count on the able stewardship of central bankers and ex-central bankers like the ones we have on our panel today. Thank you.
Thank you very much, Steve. Before we go to our panelists, I wanted to ask you, to what extent do you think Latin American policymakers should be concerned about Fed tightening, which we now know is going to happen over the next year?
Well, they are always concerned about Fed policies, and they should be concerned about Fed tightening, because history shows, number one, that spillovers from Fed policy are almost always important, and secondly, that those spillovers tend to be greater when the Fed is responding to surges in inflation, which would tend to contract the U.S. economy, rather than increases in economic growth, where all countries tend to benefit from that. So it is a concern. I will say that so far, and bizarrely, the ratcheting up of expectations for Fed tightening have actually not lifted U.S. longer-term yields by all that much, have not disrupted U.S. financial markets, and have not disrupted foreign financial markets, including for emerging markets. So I'd say so far, so good, but it's definitely among the risks that I'm sure Latin American central bankers are worried about.
Excellent. We only have a few more minutes. I want to ask Fernanda, Elan, and Jose if they have any.
Yeah, I have one question.
Yes.
I found it extremely interesting what you did in terms of estimating the Taylor rules and going to the data and trying to be very rigorous. Now, it seems to me that, except for the case of Chile, and what you show is that a country has been much more aggressive. Now, we know that Taylor rules are just guidelines of what they have operated, but they are not any welfare guidance. So my question to you is that do you have some indication that could say, okay, for example, there may be reasons at this experience to go ahead of the curve or the Phillips curve or what's really going on from the point of view of a policy recommendation rather than an equation recommendation?
Well, so I started off the exercise by saying, we don't have a clue as to exactly what's causing inflation, so we shouldn't have much of a clue as to the optimal response. And indeed, the tremendous debate in the United States over Fed policy kind of like highlights that. So I guess I would say that on the one hand, I guess all else equal, and if I stick to the logic that I laid out, I should probably guess that given like Chile's kind of like constitutional issues, pension funds, et cetera, probably the central bank should be tightening more than the Taylor rule is calling for, okay? I would add another point that I didn't want to mention for reasons of brevity, which is the Taylor rule that I'm using for prediction has a lot of interest rate smoothing built into it, and probably in a situation where inflation rates are ratcheting up quickly, the central bank needs to tighten more than indicated by that kind of like steady state Taylor rule. So those are all reasons to suggest that, yes, in this environment of political uncertainty and economic uncertainty, Chile should be tightening by more than the model predicts. On the other hand, if we kind of like go back like to before the fall of 2019, Chile was like the poster boy for excellent institutional governance in Latin America. And if you thought that some of those benefits were still operative in the country, maybe that could be a reason why the central bank does not have to get ahead of the Taylor rule. But I'll stop there, having established I don't have a clue as to the correct
Excellent.
answer.
We have time for one last comment from Fernanda, and then I think.
No, I was just actually going to make a comment on Steve's presentation and Stan's question. The impact of tightening in the US obviously have, I mean, tightening in the US obviously have impacts on Latin American countries and emerging economies alike. But how it impacts, it really depends on conditions of each country. So the fundamentals in the economy. And we've seen an extreme example of that during the taper tantrum episode, right? Countries that had worse fundamentals were much more impacted by that episode than countries that had better fundamentals in terms of their fiscal side and so on. So it is to expect that the impact is going to be different across the different countries.
Excellent. I think on that note, I'm going to bring our conversation to an end. Thank you very much to our panelists. Thank you to our audience. And I wish you all a great rest of the day.